So, Keith or someone, can you tell me, are you seeing my screen, Houston Economic Outlook, October 8th, 2020?
Yes, I can see it. See it good.
Okay, great. All right, if I was in a hotel standing on a dais, I could look over my shoulder and I could tell whether you guys are seeing my slides or not. I mean, gosh, I really do miss making presentations in person. It's just not, doesn't have the same feel. At a hotel, I could shake hands, we could visit, have a nice dessert, and here I am sitting in my home office with the doors closed, the blinds pulled so there's no glare, trying to provide some insights on the economy. So I'm so looking forward to when things get back to normal. The question is just, when will that be? But let me go ahead and get started. My very first slide, it's a tug of war. I use this as kind of to be a metaphor of what's actually going on in the economy right now. For every force that's pulling us out of the recession, every force that's pulling us into recovery, there's another force pulling against us, pulling us back into recession, or at least preventing us from making any progress coming out of the recession. And let me go through, let me talk about what's pulling us towards recovery is things like durable goods orders and merchandise trade, home, auto, and retail sales, and consumer sentiment. They all seem to be pulling us towards recovery. Let me give you some examples. Durable goods orders rose for the fourth straight month back in August. Durable goods, one of the common definitions of it is a good that has a lifespan of 3 years or more. You would think an automobile as being a durable good. An oil rig is a durable good. A truck or a computer could be a durable good. Non-durables are things which are easily consumed or have a short lifespan. Food is non-durable, clothing is non-durable. But what's good is durable goods orders also tend to be investment goods. That's where you'd find lathes or oil field equipment or forklifts and stuff like that. So the fact that we see durable goods orders picking up shows that the business community out there is getting a little bit more confidence and willing to make some of these investments that they're going to be using for production capacity later on. If we want to get some idea where durable goods orders are here, this is from the Census Bureau. And I took defense spending out because defense spending tends to skew this. And you can look and see how far durable goods orders fell during the worst part of the pandemic and how far they've recovered. Now, they're not quite back to where we were prior to the pandemic, but you can see this is really a nice increase right here. And you can follow it all the way across. It's better than we were seeing in 15, 16, and early parts of 17, but not quite as good as it was before we went in there. But the point is, durable goods orders are up. Global trade is actually returning faster than expected. It's very important to Houston. There is a study done by Brookings Institute a couple of years ago, and they said that about 17, 18% of Houston's economy is tied to exports. It's probably even more so now because that study was done about 4 years ago. And it's not just goods that we export. We also export a lot of services out of Houston. Think of the engineering firms, think of the consulting, think of the people who come to Houston for medical treatment. But just the goods, tangible things you can touch, things you can put on a ship. And you can see we are here right now. If you look at this light gray line is how long it took for trade to recover coming out of the Great Recession, out of the financial crisis of 08, 09. And the red line is where we are coming out of the pandemic. And you can see after 3 months coming out of the pandemic, we're pretty much where we were a year coming out of the financial crisis. So we are starting to see global trade of goods and commodities picking up. Another way you can look at it, this is something that I pulled from a website. Unfortunately, they wouldn't let me download the data. I hate that when you go, as an economist, we're always downloading data. We want to create charts. But what I did is actually clip this and put it there. And you can look and see on the year-on-year growth where we were at the worst part of the pandemic in April and May. And you could see goods trade in the European Union was down by about a third. You can look and see where it was in the United States and UK and so forth, and you can look at imports. But you go over here for June and July, the most current data available, and you can see it's only down 7% versus being down 33% in the European Union at the height of the pandemic. You can see for the US, it's only down 15% when it was down 29%. If you want to look at imports, shows a similar picture. So yes, we're not back to pre-COVID levels, but we've made some really nice progress there, and we're actually proceeding faster than we were coming out of the Great Recession. New home sales climbed to 1 million. It's the fastest rate since 2006. And you have to think that 2006, 2007, that was still during the lending bubble that we had, the problem where a lot of people were getting loans that shouldn't have been getting loans. That was during the housing boom that led to the housing bubble, which led to the housing bust. And this is not any sort of bubble. This is consumers feeling more confident about their jobs and extremely low interest rates. You can get a 30-year loan for less than 3% now. Absolutely incredible. But if you want to see where we are for new home sales, you can see they dipped just a little bit at the beginning of the pandemic. And then you can look and see how they were. You know, you consider everything that's happened since the end of the Great Recession, and they're at the highest point. So new home sales, and it's you know, that's construction jobs, but it's also manufacturing jobs for the materials that go into a home. And think about it. I mean, we moved in a new home 2 years ago, and my wife said, we're not taking that couch with us. And so resulted in furniture sales, and we bought drapes and so forth. So the fact that new home sales are picking up, and they're really bodes well for the rest of the economy. If you want to look at existing home sales where someone's going to move out of their current home and they want to upgrade to a nicer home, or maybe they're moving out of their current home because all the children have gone off to college and you're looking for a smaller place. But you can look and see existing home sales have really jumped, and you can see that here. And you can see how high existing home sales are. And part of what we're seeing is, one, it is the low interest rates, and also families and homeowners and couples saying that if we're going to be in this environment where we're working from home, maybe not permanently, but maybe we're going to have a situation where we'll be working from home even when we get back to the office, we'll still be working home 1 or 2 days a week. So people want nicer houses to work in, or they need an office. They need to make sure there's some way to separate the work environment from the home environment. And that's one of the things that's been spurring home sales. So these are the sort of things which are kind of tugging us along, pulling us out of the COVID downturn. Auto sales up to a huge pace. You can definitely see the drop off during the COVID, the worst part of the pandemic. And you can pick up, they're not quite to where they were before, but this is still a fairly healthy pace. We're going to finish the year with over 15 million in auto sales. And you see that's picking up. You can almost look at an automobile as an indicator of short-term confidence. Now, most rational consumers aren't going to go out and buy a new car if they think they're going to lose their job in the next 6 months to a year. And you kind of look at home sales as maybe being long-term consumer confidence. People are setting down roots. So this bodes well. This is suggesting that the consumer is feeling a little bit better about the economy. You can see that in retail spending as well. It's up, maybe not quite as much as it was up in July, but you're always going to see a bounce back the first month or two after a downturn. Well, think about it. COVID has been referred to as being a natural disaster of sorts, not quite like a hurricane or tornado, but think back about after Hurricane Harvey hit the region, and how retail sales surged because people were having to replace everything that was lost, or surging as they were moving into new homes out of their old homes. And it's pretty much what we're seeing. People weren't able to shop early on in the pandemic. They could only do it online. And so now you're starting to see this increase in retail sales. But also what you're seeing is because of social distancing and because of the need to wear masks and take all those precautions, consumer purchasing is actually, we're seeing a shift in it. And consumers are more interested in purchasing things than experiences. They are buying nicer couches, or they're buying nicer dishware, or they're investing in a new TV, all sorts of things, because they realize they can't travel, they can't go to the symphony. And so we're seeing a little bit of a shifting there in consumer spending. If you want to see how it looks on a graph, you can see it right there, and you can see retail sales. And I took out food services. I took out restaurants and fast food and bars, and you can see how retail sales, seasonally adjusted, are really have very nicely recovered from the downturn. And then you can see consumer sentiment. It rises in September. It's the highest level this since March. This is the Michigan Consumer Sentiment Survey. There's another one that's put out by the Conference Board. Conference Board is even more bullish. It shows a really even stronger rebound in consumer sentiment survey, consumer sentiment based on surveys. But there is just a little bit of a difference between the two. The Michigan survey tends to be more broad-based. Somehow or another, the Conference Board tends to deal more with upper income households. So either way, whether the broad-based survey or the upper income household survey, both of them are feeling pretty good about the economy. And you can see it right there. This is the University of Michigan. Not as high as it was prior, but we are seeing this it's up off the bottom. So what's pulling against the recovery? Excuse me 1 second. I have to have a sip of Earl Grey so I can continue talking. Okay. COVID cases are picking up. Very concerned about that. There's some weakness in the global economy. The other side of foreign trade, the trade and services, is not doing as well. Unemployment claims remain elevated. The stock market has been in turmoil. It's been up the last 2 days, but that was after about 4 weeks of it being down. And we still don't have a stimulus package. Now, there's a story on NPR about this a while back. We're in a various situation. Now, the World Health Organization said coronavirus cases are rising in Europe again. You've heard about it. There's especially in Spain, they're on the rise, and there's concern in the UK and in France. This comes from the Johns Hopkins University Coronavirus Resource Center, and they're looking at the 7-day moving average of cases, and you can see, and these were the countries that were tracking because they had the world's highest rate of infections. And if you look at this, you only see 4 of these cases where the cases are declining while the others are on their way up. And that has an impact for healthcare. It has an impact for consumer confidence. It has an impact for whether we can continue to reopen the economy or whether we're going to have to ratchet back some of these. The global economic recovery, it is showing some signs of slowing. You can look at it. This is IHS Markit is a global economics consulting firm. They do a survey of businesses throughout the world. They put together all these different purchasing managers index or PMIs. And you can look and see how far the European PMI fell back in the height of the COVID pandemic. And you can see it pretty well recovered prior to where it was, but then it's slipped back down again. So it's a little bit of uncertainty there about the recovery in the Eurozone. If you want to look at Japan, it shows almost a similar pattern, but it never got quite back up to where it was prior to the pandemic. But you can see this nice rebound and this little bit of slowing there. And you can look at Australia. Australia's have very similar. Australia did very well. This one's on a scale of 50, and they need to be above 50. The other was a scale of 0. But you can see it surged and went above 50 and then back down. So we're a bit of a concern there that there's a little bit of slowing in the global economy. It may be just the fact that when you come out, there's this bounce immediately when you come back out. It's like throwing all the doors and windows open in Houston in April. The winter's over. Let's let the fresh air in. And then May comes around and you have to close the windows and doors again and put the AC on. So what we may be seeing, what we saw was that initial bounce and then it kind of settling back in. I'll talk a little bit more about that when we talk about some job numbers. So when I talked about the trade in goods is doing well, the trade in services, we haven't seen quite the same level of recovery. You know, services would be tourism, could be insurance, could be software, could be consulting, could be engineering. And the U.S. has done very well with the surplus in services, even though it's had a deficit in merchandise. But you can see how the rate of recovery and the export of services is not doing quite as well. Part of it's tourism, part of it's travel. We're still trying to maintain social distancing as you're not allowed to fly. As there's still some concern over the outlook for the economy. We're not seeing quite as strong a rebound here. It's kind of interesting. A lot of the previous recessions, they've shown up most in construction and manufacturing and in mining. And those have been the services have recovered first and manufacturing has recovered last. This time, with the exception of oil and gas, all the goods producing sectors, the construction, the mining, the manufacturing are actually recovering faster than some of the service sectors. If we want to look at still have a high level of jobless claims, and that's slowing the labor market's recovery. These are initial claims for benefits. This is US data. I'm going to show you some Houston data in a little bit. We had, back in the worst part of the pandemic, we had almost 7 million people a week filing unemployment insurance claims. And that's trended down. But if you look here, since August, we've still been in this range of over 800,000. If you go all the way back prior to the pandemic, we were doing less than 300,000. So we're 2.5 times the level of initial claims for unemployment insurance that we should be having. So that still shows there's a lot of softness in the job market. We were talking about this earlier. The danger is for when you lose 800,000 jobs, you have to create 100,000 jobs just to stay at zero. Then you create another 800,000 jobs. So you have to create 2 jobs for every 1 job you lose to show some sort of growth. And with what we've been hearing about the airlines, and now we're starting to hear it about some of the banks and financial institutions, everyone probably saw the Disney news, 28,000 people there. So this is one of the things which is showing kind of my old tug-of-war analogy or metaphor, it's pulling in the opposite direction. Now, really concerned if you go back and look at the Great Recession, at the worst part of the Great Recession, we were only at about 600,000 claims on a weekly basis. And that was the worst part. The worst for us was 7 million. So we are still now having initial claims higher than we had them at the worst part of the Great Recession. And so these are people who don't have a job. On one hand, you can say they don't have a job, so don't have the income to spend unless they're spending out of savings or running up their credit cards, because we've severely cut back on the benefits package. But also means there's this, whatever they were doing, that productive capacity, whether it was in a plant or on a construction site or providing software consulting or something, is also gone from the economy. Stocks, they haven't done real well. This week's been kind of up and down, not knowing what's going to happen with the stimulus package. But you can see what happens with I just put the S&P up there, and the drop. We had this real nice recovery, and then this drop again. And there's an expression out there that the stock market is not the economy is not the stock market. But it is kind of a barometer of investor confidence about how they feel earnings are going to go, or how revenues are going to go down the road. And so it's showing that there's just a lot of concern. And you hear that in the anecdotes, is until we get a stimulus package, we're not going to see much recovery. It's affecting Wall Street. You can also look at it another way is, I have a 401k. I'm sure a lot of people in the call also have a 401k or an IRA. When I look at my statement and I see it's going up, I feel good. I might spend a little bit more money out of my regular paycheck because I know I've got this nice, but when I see my 401k shrinking, it makes me just a little bit nervous. And I might hold back on some purchases. Economists refer to this as a wealth effect. If your perception is that you're better off, you're likely to spend more money. If your perception is that you're worse off, you're going to spend less money. And so that's one of the impacts that we're seeing from the stock market. So, it's a tug of war. And, it's a stalemate right now, pulling us one way, pulling us the other way. If you ever watch the tug of war, there's usually somebody who likes to come out with a water hose and spray the ground around the feet of the people who are pulling. And depending upon where they spray and how much they spray, we'll figure out, which team wins the tug of war, who pulls the other side in, who's lost their footing. Right now, that water hose is a stimulus package. We're definitely seeing the economy slowing down. And what we need to do to give that extra boost, we need some form of a stimulus package. You look at it 2 ways. One is a stimulus package to help the economy to continue to grow, because we are struggling still in a lot of areas. The other is we need a benefits package, because there are a lot of people out there who are not earning a paycheck, who've drawn down their savings, who are running up their credit cards, that need the stimulus just to continue to get by. And by giving them their check, they're going to spend that in the grocery store. They're going to spend it at and the hardware store. They're going to go out and eat out maybe. So the checks that we give individuals is not just a safety net. It's also a way to get new money back into the economy. So with that, let's just give you a quick update on some national job numbers. You can see it right here. This is the monthly change in U.S. employment. That middle bar shows you, March, we started shutting down mid-March, lost 1.3 million jobs. Totally shut down in April, lost close to 21 million. And then we started reopening. And you see we had this nice bounce up, but if you look each one consecutive month of job creation, it's just a little bit lower than the last. I've kind of used the analogy. It's kind of like bouncing a ball or dropping a ball from the garage roof or from the top of a ladder. And it bounces real high the first time and it continues to bounce, but each successive bounce is a little bit shorter than the one before it until finally there's no bounce left at all. That's my concern with the lack of the stimulus package. These bounces are getting shorter and shorter and shorter, and we may hit a month where there is no bounce at all in the economy and we have no job growth at all. So let's hope that Washington, and I'm not pointing fingers at anybody, let's just hope Washington can figure out that we still need a stimulus package. So kind of sum it up, we had lost over 22 million jobs. US, we recouped about 11 million. We've got roughly 11 million to get back. That's a huge number of jobs, rounding up at 11 million. If we're still creating jobs at that rate of 600,000, which I doubt we can continue to do that, you're still looking at 20 months of job growth at that rate just to get back to where we were prior to the pandemic. Now, what I'm saying is it's going to take us a while to recover everything we've lost. We will see improvements and production improvements throughout the economy, but the way these things have worked the last few downturns is you can actually have a recovery in production capacity, recovery throughout the economy, but without having a very strong jobs recovery. As you put idle capacity back to work, as the workers who remain on the shop floor or in the office are the most productive. So let me keep on going. If you want to look at continuing claims, these are by definition workers who've been unemployed for 2 or more weeks and have to file a second and a third or a fourth claim. Every week they're out of work, they have to file a claim to continue to get benefits. It was up to close to 23 million at the worst part of the pandemic. It's 12.7 million now. And it's almost twice of where it was at the peak of the Great Recession. And this doesn't include the others out there that are collecting benefits, the gig workers and so forth, the special allowances we made for them out there. So there's still a lot of people out there out of work. The good news is we are going to see some growth this quarter. The Wall Street Journal does a survey of about 60 economists out there. These are economists who work for large corporations. They're in academia. They work for the government. They work for consulting firms. Some are just independent economists. I know 1 or 2 that simply have hung up their shingle. They practice economics and they will talk to anybody who will pay them. So, but they survey these economists and ask them what their outlook looks like for the economy, and they come up with a consensus or an average. And the last time the Wall Street Journal did the survey, the consensus was the economy will grow about 24% this quarter. You need to realize that last quarter it shrunk by 32%. And then we start to see the growth tapering off. Once again, that gets back to my metaphor, is that ball just not bouncing as high with each consecutive bounce. But the consensus out there for most economists is that we will see continued growth, but the big surge in growth occurred here in the third quarter. This is, I need to explain this one, and there's a backstory behind this. Every now and then I get calls from the media, and they'll start with the assumption, well, because oil and gas is suffering, Houston must be doing worse than any of the other metropolitan areas out there, because we're dealing not just with COVID, but we're dealing with oil and gas as well. And that must really be depressing us. The answer to that is a flat out no. And I illustrate it by this chart that you see in front of you right now. What I did is I looked at where employment was in each one of these metro areas. These are the 20 largest metro areas, where employment was in February and where it was in August. So August as a percentage of February. And right now you can see Houston in the middle. We have about 92.5% of the jobs that we had back in February. We're pretty much in the middle of the pack. Now, if the oil and gas industry was severely holding us back, you would expect us to be further along the axis to the right-hand side. And if you look at some of these that are suffering, look at New York and San Francisco and Boston. New York, a lot of it has to do with, one of it's tourism, and the others, you've got the offices haven't opened back up in Manhattan, so all those jobs supporting office workers are gone. San Francisco, people are staying at home, sort of same thing and they're working remotely. They may be working in Montana now, so they don't have to pay the high costs of working in San Francisco. Boston has a lot to do with education, Detroit, automobiles. Los Angeles seems to always kind of lag behind the rest of the nation. But you can look here and see that Houston, we're not that much worse off. We're not that much better off. We're pretty much the middle of the pack. And getting back to what I said earlier, you would think that with the drop off in oil and gas would be much worse off, but there are the parts of the economy that are adding jobs. They're offsetting what we've been losing in oil and gas. We've been losing oil and gas for quite some time. I don't know how many more jobs we can lose and still have an oil and gas industry. I'll talk about that in a minute, but if someone says, or if someone believes that Houston is so much worse off than the rest of the nation because we're too tied to oil and gas, right now, we're about the middle of the pack. It's kind of funny coming from the Great Eastern Partnership, the big chamber in town, that I'd be happy to say we're about average. Who would ever thought that a Houstonian or a Texan would be happy with being average? In the current environment, yeah, I think I'm okay with being average, considering that we could be a lot worse. So now let's talk a little bit more specifically about Houston. And excuse me 1 second, I need another sip of that Earl Grey. Anybody remember Jackie Gleason from the 60s and his coffee cup? I'll let you know, yes, I have Earl Grey in my coffee cup. I do not have what Jackie Gleason had in his. So this is Houston job growth. Some of these numbers are going to be a little bit mixed, but they tell the same story. When I say mixed, there's a problem. We can't get everything I need, both seasonally adjusted and unadjusted. But I just want to show you seasonally adjusted. You can see where we are. And once again, now that 365,000 jobs lost. And you can see the bounce come down a little bit better in August, but not quite the job growth that we had hoped that we would be seeing. Initial claims, once again, you can see where we are. We're seeing this nice trending down. Our trend is actually doing a little bit better than the US trend. But you can look at here at 9,000 claims. It's still about twice of where it should be. But we're definitely a lot better off than we were at the height of the pandemic when we were getting 76,000 claims filed in a week. But once again, this is another 4,000 workers this week that have seen the need to file for claims, have lost their job. This is continuing claims. You need to go all the way over here to this far right-hand side, and you can see, let's just call that 230,000 claims. It's gone down a little bit as people have found work and then have to continue to file. But if you look at where we were in March, we were only at about 33,000. So it's still about 190,000 people who are having to file a continuing claim who had a job back in February or back in March. Got to put this in perspective. This 230,000 that we see in August of 20, at Hurricane Harvey, there were only 41,000. At the worst part of the Great Recession, there were only about 70,000. So you see, we're 3 times the level we were at the height of the Great Recession. You can see Hurricane I. So there's still a significant number of workers out there who've not been able to find work. We're having to file week after week, still file a claim asking for employment benefits because they're not working and they need the money to feed their family, to pay their bills, pay their rent. So kind of summarize it up. This one's not seasonally adjusted. I had to shift because I'm going to show you some different details. So if you look at 350,000 jobs lost at the height of the pandemic, 113,800, say 114,000 recouped. So it still leaves us, in this regard, it's about 235,000 jobs still to be recouped. Now, not tomorrow, but next Friday, we'll be getting the September employment numbers. And I'm really looking forward to hopefully that this number will be a lot bigger and this number will be a lot smaller. And I'll talk to you a little bit about that as we go through. So a lot of data on this slide. I almost put too much data on it. I thought about breaking it up into separate slides, but it kind of helps to give you kind of the big picture of where we are. Some of these sectors have lost more jobs than this, but they've recouped them. This is where we are now. This is kind of meshing in together all the job losses and all the job gains by sector to find out where we are. And you can see restaurants and bars, roughly 42,000 jobs shy of where we were. A lot of that is weighted to bars, but also restaurants. Governor Abbott said that bars can open up, but he's going to leave it to the county judge's discretion, and our judge has decided that we don't need to open up the bars. That government sector right here, roughly 41,000 jobs, that number is going to drop dramatically because what's in there is we always see a significant loss of government jobs in June, July, and August. And that's because the government jobs include education, public education, jobs at school districts, jobs at community colleges, jobs at state-funded universities. And it's just part of when students aren't on campus, when all you have is a little bit of summer school, we always see employment go down in education and then pick back up. I wouldn't be surprised if we see, when we get over here, this number that is 41,000 roughly now, drop down to 10,000 by the time we get the October data. Construction improved just a little bit, but we're horribly overbuilt in a number of sectors, like apartments, office, and industrial. We're finally starting to see a little bit of a pullback in industrial construction, not so in apartments, but we are starting to see businesses, construction firms having projects canceled or put on hold, and I'll talk a little bit more about that now. So much of what we see in manufacturing is tied to the oil and gas industry. Healthcare and social assistance, you need to pay attention to the second two words or the last two words in this. Healthcare is doing a lot better. Social assistance still struggles. And the government lumps a lot of things into social assistance. One of the things that's in social assistance is daycares, privately operated daycares. A lot of daycares had to shut down during the pandemic and have not yet opened up. So we're probably seeing at least 2/3 of what's still lost. And healthcare and social assistance is probably related to the daycares that haven't been able to open up. Wholesale trades tied to oil and gas, particularly, this is where energy falls, mining and logging. That's the broad category. That's where exploration and production falls, oilfield services and so forth. And you can look, if you look down, sectors that have seemed to have done the best is professional, scientific, and technical services. It's white collar operations. A lot of that stuff can be done from home. You don't need to sit at a lathe. You don't need to stand over a stove. You don't need to be serving people at a table. That's recovered fairly quickly. Administrative support, a lot of that is contract workers, where employers have brought on contract workers to do the work until they can figure out whether we're into a full recovery or whether we might have a slowdown or so forth. But this kind of gives you some idea. By the way, Bobby, we didn't discuss this beforehand, but I'll let you know that when we're done, I will email you a PDF of these slides. And if anybody wants a copy of the slides, they can just reach out to Bobby and Bobby will share them with you. Oh, let me try another button. There you go. So how are we doing in the recovery? If you want to look at where we are, this is once again that concept of what percent of jobs have we recovered from what we've lost. Finance and insurance has gotten back all the jobs it's lost. Part of that is this boom in refinancing. Part of it was the original efforts with the PPP loans. One of the bankers I talked to told me they had as much loan business due to PPP in 2 months as they normally get in 12 months. And so they brought on some staff to deal with that. Administrative support, part of that's due to the reopening. This is the contract workers, but it's also janitorial services. It's also security services, landscaping services. So as businesses start to reopen, you can see an increased demand for that. Retail trade, I'll let you know I'm skeptical of these numbers. I think they're overstated. And then you can see this white collar professional, scientific, technical services. So those are the sectors which seem to be doing the best towards recovery. Others that have made good progress, restaurants, healthcare, other services, arts, entertainment, and recreation. Other services is where you'll find personal care services. That's where you would find a nail parlor, a beauty salon, a barber shop, appliance repair, auto repair, so forth like that. A lot of, especially the massage envy, places like that, those places all had to shut down during the pandemic. And so you see the reopening has helped them out somewhat. I suspect arts, entertainment and recreation is going to continue to struggle though. We may have seen we're going to recover there. You have the museums there, the water parks, you have sports venues and so forth fall into there. And with what we've heard, especially like the nature of the announcement from Disney, This is the sector that's going to have a hard time getting past where they are now. See, real estate, rental, and leasing hotels. I'll leave these up for 1 second, let you look at them. That top sector, you need to realize a lot of this is in rental and leasing. This is where the government has lumped in the rental of equipment. And that could be a bulldozer. It could be an automobile. It could be furniture and so forth. That struggled. Hotels, no one's staying in hotels. Educational services. I think this is a number that's understated. I think it's done better. This is private sector education. And you could see there, let's go on, the ones that are still losing ground. We're still losing jobs in government, but I told you I thought that that's going to change real quick as we start to hire back for the school year. And some schools have been open since mid-August. My wife's school's been open since mid-August. She teaches in a Catholic school. But they aren't going to show up until we get further into the year because of the way the data is collected. So I imagine that we're going to start to see a lot more improvement. But the manufacturing here is tied to the oil and gas industry. And this is the oil and gas industries in mining and logging. And information, that's where broadcast media, newspapers, and so forth fall in, telecommunications. And that's just part of a long-term trend there. So one of my big concerns, and I've used this in other presentations, my wife was giving me a hard time. She said it's too difficult a concept to understand. I said, this is a bifurcated recovery. And she says, why don't you just tell it it's recovering different ways for different people? And that's kind of what we're seeing right here is the downturn has affected lower skilled and lower wage occupations more severely than it's affected the upper skilled and the higher wage occupations. And so far with the recovery, those who have the higher skills and the higher wages seem to have fared better in the recovery than those with the lower wages. Think about what fits into a lower wage. It's going to be wait staff in a restaurant. It's going to be retail sales. It's going to be bartenders and so forth like that. It's going to be people working for minimum wage. While the high skills are these white collar workers, things which can be done from home, while these are those who can be working remotely. And so you can see they're not really recovered nearly as well as these other sectors have. I'll let you know, this is a little bit of my concern right here. You can see the recovery and you also see a little bit of a plateauing right here. And so that's what I'm talking about, how that ball isn't bouncing quite as high. And now we've got some factors pulling one way or factors pulling the other way. So let me talk a little bit about energy. I can't make a presentation in Houston to any audience without saying something about energy. It's kind of in our blood here in Houston. If it's not in our blood, it's in your next door neighbor's blood because he or she probably works for the energy industry. And I just share a couple of headlines. Schlumberger sells its frac operations to Liberty Oilfield Services for 37% equity stake. Think about it. The largest oilfield service company in the world has decided there's no opportunity in the North American fracking market anymore. We're getting out. Exxon Mobil has been dropped from the Dow after 92 years, replaced by a software stock. Maybe you saw it was in the Chronicle today that as far as market value, Chevron now actually has more value than Exxon does, market cap wise. If you look at BP, unveiled this great strategy, how they're trying to move away from hydrocarbons and embrace more the new technologies, clean technologies, low carbon footprint, and investors just punished them. They bid the price of the stock down the lowest it's been in 25 years. And even Halliburton and Baker Hughes are looking at just how uncertain things are out there. Now, the oil industry is really struggling. We've seen the layoffs, we've seen the pullback in the rig count. And it's kind of, I think the Washington Post summed it up fairly well with an article when they said big oil just isn't as big as it once was. It's just not as big as it once was in the US or in Houston. And if you want to look at, one of the things they're struggling with is low oil prices. This is the monthly average price for crude, West Texas Intermediate on the spot market. God, it's amazing. Can we think back 6 years? Back in June of 2014, when crude was selling for over $100 a barrel. And when it got down to $30 a barrel, we thought it would never get that low again. And then we had that fluke back in April, which pulled it down below 20. And right now it's trading at around $40 a barrel. That's just too low a price of oil for the industry to be very profitable. And this is a lot of data on this, but listen to me first. This is a survey that the Federal Reserve Bank of Dallas does. They ask the companies, the producers in their territory, what price of oil do they need to operate an existing well at a profit. I mean, the well's already drilled, it's already producing. There are always costs to maintain a producing well. And you can look at that and you can see the average in the Eagle Ford is about 23, different parts of the Permian, 26, $20, other parts 32. And so, at the current price level, they can operate their existing wells at a profit. Of course, you get some of these that even at $50 a barrel, they cannot operate profitably. So that's one reason why you've seen the rig count fall, but this is probably the bigger reason is they ask the same question, what price do you need to profitably drill a well? And the average goes from 46 to 52. So let's just say on average, the industry in the US needs about $50 a barrel to profitably drill a well. And I just showed you where we are. We're at about $40 a barrel. And so when you see oil price is so low, that's the reason why the rig count has fallen. And once again, at the fracking bust at 404 rigs, I never thought I'd see the rig count get any lower than that. It got down to 251 rigs, and now it's back up to about 266. But with that, when you're drilling so few wells, you hear about people, they stack the rigs or they lay down the rigs, they mothball the rigs. So it's not just the fact they're drilling fewer wells, but if you're drilling fewer wells, you're not buying any new equipment. If you need anything new, you just cannibalize an existing rig. So that affects the manufacturing jobs back in Houston. And if you're only drilling a fifth or a sixth of the wells that you normally would be drilling, you need fewer people to supervise those operations, and that gets back to the office jobs in Houston. And these are good paying jobs, as I'll show you a slide in a minute, and that has other effects on the economy. But once again, I find it very interesting with as difficult as the times are for the energy industry, we are about average on where we are in our recovery. Let me show you a few more oil slides. You can see US crude production got up close to, on a monthly basis, close to about 13 million barrels a day. Latest data had it around 10.4 million barrels a day. So not only are we getting less for the oil, but we're producing less of it. So, you can do the math. Lower prices, lower production equal lower revenues, equal lower profits or no profits at all. But this is probably one of the scariest charts I'll show you. And it came from that same survey that the Federal Reserve Bank of Dallas put together. They asked the respondents, do you think US oil production has peaked? 2/3 of the companies, 2/3 of the executives responding to the survey says they think US oil production has peaked. Now we need $50 a barrel to be able to produce more oil. And we're looking at $40 a barrel. And if you look at the forecasts out there, we won't get to $50 a barrel for at least another 12, if not 18 months. All sorts of different forecasts out there. But even if you look at the futures market, it shows based on futures market that we're not going to get back to $50 oil for quite some time. So this is the second scariest chart I'll show you, or maybe it's equally scary. This is energy industry employment in Houston. And I need to let you know how I define this. This includes the exploration and production jobs, the oilfield service jobs, the manufacturing jobs, the manufacturing of pipes, valves, and flanges and oilfield equipment, and engineering. And you can see at the height of the fracking boom, we had 300,000 people working in upstream energy in Houston. We had the drop of the fracking bust, but then we started this gradual recovery. But then you can see the drop off again. And if you just follow this line across, you can see, and we're at about 207,000 jobs. So we've lost roughly almost 100,000 jobs from our peak. We've lost roughly 1/3 of the jobs we had in this. And we are where we were in January 17, you go January 2010, almost back to 2006 levels. And the thing is, when we hit this level or this level or this level, we hit it on the way up. Now we're hitting this level on the way down. I'm real concerned over the next month or two as we start to get these additional reports from the Texas Workforce Commission on employment that we may see that energy employment in Houston has fallen below 200,000 jobs. So it's not just an industry, but it's also the opportunity to earn just a really good living in the oil and gas industry. It is the highest paid sector in Houston. These are average weekly wages. It comes from the Texas Workforce Commission. I pulled it from the fourth quarter last year. So you can see the average weekly wage on the exploration production side is $200,000. Now there's some bonus money in there, but think about that, $200,000. This wage up here is three and a half times this wage, this metro average. First, you can see that's at three and a half times the metro average. You look at engineering, oil field services, oil field equipment, even someone who's working on a shop floor, manufacturing equipment, a blue collar job can make $100,000 a year. But unfortunately, these jobs are going away as the energy industry continues to shrink. But it's not all bad news. There are some firms out there that think this is, excuse me, a temporary phenomenon. Citi, which has got just an extensive energy practice and research team, actually think that we're going to see oil back to $60 a barrel in 2021. That would be great. I hope that would happen. I just hope that when oil gets back up to $60 and we ramp up, that all these laid off oil field workers haven't left Houston and gone somewhere else, so they can get their jobs back. And there are other companies out there that disagree with some of the pundits. ConocoPhillips is one of those that thinks oil demand will return and continue to grow. Now, we talk about the weaning us off oil, off hydrocarbons, and trying to move as much as we can to electricity. That may be fine for power generation or trying to have electric vehicles and so forth. But I often ask this question. I'm not in front of the audience, so I can't ask for a raise of hands, but I'm just going to put a hypothetical. Prior to the downturn in the COVID, downturn impacted by COVID, how much crude do you think the world consumed in a typical day? How much crude do you think the world consumes in a day prior to the downturn for COVID? It's actually close to 100 million barrels a day. Right now, we're back up to about 91 million barrels a day. So my question, if we're going to try to move from hydrocarbons, how do we find an energy source to replace 90 to 100 million barrels of crude a day? It's going to be, so we definitely need to do it. I'm, like everyone else, I'm concerned about the climate. I want my grandchildren to grow up in a great world, a healthy environment, but there's still going to be a need for hydrocarbon for a while, but we need to manage this transition. And so, and some firms out there are, I wouldn't say hedging their bets, but they're diversifying. You can see places like Halliburton are looking at ways to launch clean energy efforts. So let me get back to Houston in general. Talk a little bit about what we see going on in Houston. Once again, we have some of the same things going on in Houston as we see going on in the U.S. economy. We do see that tug of war going on. The Purchasing Managers Index, the PMI, this is a survey the Institute for Supply Management does. If you've seen me present before, you know this is a chart that I include in just about every presentation. Ask that question, the purchasing managers, what's your backlog like? What's employment like? What prices are you getting for your finished goods? What are you having to pay for your intermediate goods or your raw materials? Are you hiring and firing? And all sorts of questions. And when they get that results, they crunch them and come up with an index. And whenever the index is this blue line or slate colored line, at least it's slate on my computer. And whenever that slate colored line is above the red line, that's a sign based on the activity purchasing managers are seeing out there that the economy is expanding and should continue to expand for the next 3 to 4 months. When it's below the red line, that's a sign of contraction. And you can look over here, 09, it lines up real well with the Great Recession. Here's a fracking bust when you look at 15 and 16. If you look at this little dip right here, that's Hurricane Harvey, 17 and 18. And then here you see the COVID downturn, pick back up. And once again, you can see, the economy, the service side tends to do okay when it's only at 45. Manufacturing tends to do well when it's at 50. Right now, it's around 53. I think it's 52.7. So we're doing well for both manufacturing. Of course, that's going to be non-energy manufacturing and services in Houston. However, even though manufacturing seems like it may have stabilized, the people out there aren't getting as many hours as they used to. If you kind of look at this as a measure of activity in the plants, and when things are going great, average work week, get 8 hours of overtime in. Now, as we're struggling, you're not even able to get a full weekend. So that's one of the things we need to be watching. If we start to see the number of hours that are being worked in manufacturing going up, now that's a sign that there's an increase in demand for stuff that we're manufacturing in Houston. But once again, this is one of those things that, yes, we see the PMI signaling that we're going up, but we're really not seeing an increase in the number of hours worked in manufacturing. If you want to look at construction starts, this is Dodge Data and Analytics. It looks like we're down significantly, and you can see this drop off of about $3 billion compared to last year. But if you ignore this far side and you look at far side, Gary Larson, if you look at this over here, commercial is about where it was this time last year, and residential is about where it was this time last year. So a lot of the drop off has been in, oh, let me back up one. Don't read that. So look at this. A lot of the drop off has been in this non-building, and that's, think about the slowdown of the manufacturing along the chemical plants, the refineries and so forth. A lot of those have been put on hold or pulled back, and that's what we're seeing. One of my concerns, though, moving forward is that we saw a lot of projects canceled. These are survey done by Associated General Contractors, asked their members about contracts being canceled or projects put on hold, and you can see projects in August, July, June, and May. Almost all of them had, or a significant number of them had, projects put on hold or canceled. And the businesses are just trying to figure out what's going on. Should I really put up this office building? Should I build this warehouse if the demand isn't going to be there? So that's going to eventually start to impact construction employment and the sale of construction materials. Port container traffic is up. These are containers going through the Port of Houston. And you can see where we were in March, the drop off as everything shut down, and we handling about 24,000 fewer containers in March. You can look here and see that we had maybe 20,000 fewer, 23,000 fewer, but you're starting to see this gap getting shorter and shorter. And we're getting back to pre-COVID levels of container traffic at the port. And that's good because that gets back to that slide I showed you a lot earlier about this increase in global merchandise trade. And so a lot of what goes out of the port is manufactured here. And so that does suggest that maybe a little bit of improvement in manufacturing for the region. But the airport, the other side of transportation, still struggling. You can look this time last year, August handled about 5.1 million passengers, only about 1.6 million now, less than a third. If I had showed you this chart with our April data, it would have been even worse. Right now we're down by about, what was that, roughly 70%? We were down 90% back in March and April. If you want to look at August, you need to remember that was when Hurricane Harvey hit and we lost a lot of traffic there. So if you want to look at a more normal period, we should be handling close to 5 million. We handled less than a third of that. But restaurants are starting to pick back up. You can see this done by Open Table, where they're going and looking and trying to figure out how many seats are occupied in the restaurant today versus the exact same day last year. So you can see 100% were unoccupied during the height of the pandemic. Now it's anywhere between 25 and 30% are unoccupied. A little bit of a downturn, but you can see there's a little bit of noise in data. And when we pull the data the next time, hopefully we're going to see this picking up a little bit. Another sign, though, that maybe a little bit more bright hope, we are starting to see a bit of pickup in sales tax collections throughout the region. You know, there are over 100 cities that collect sales tax. I just try to collect the 12 most populous. They represent about 80% of all the sales tax collections there. And you can look and see, you know, when you aggregate those 12 together, where we were in February, just slightly down, but you can see definitely the drop off. And this reflects not just consumer spending, but business spending. And we think of sales tax as when you go in and buy a new shirt, or you're buying garden tools or lumber or something, but businesses pay sales tax on their purchases as well. And you can see how both the consumer and business side are simply spending a lot less. But now we're starting to see it pick back up. And you're seeing that drop off in July was just not nearly as bad as we saw as this drop off here. So that's an improving sign. Home sales, home sales are up. We're going to probably have a record number of home sales to the Houston Association of Realtors. Right now, we're on an annual pace to do about 105,000. But housing inventory is way down. And we may not be able to hit a record pace if we don't get more homes on the market. We saw a drop off in inventory earlier in the pandemic because people didn't want to list their houses because they didn't want people coming in and perhaps exposing them to the virus. Now there's a drop off in inventory because we can't get enough of them into the system to be purchased and sold. So how long are we going to have to wait for the recovery? I keep on saying we are in a recovery. We're being tugged out of it by some positive factors, kind of held back by some negative factors. So how long is it going to take for us to get out of this downturn? And what's so important for Houston is that the U.S. economy recovers, because we're not going to get any help from the oil and gas industry this time. Last time we had a downturn, if you remember the Great Recession, we came out of that pretty quickly, and the region recouped all the jobs it lost in 22 months. And that's because of a little something that maybe some of you guys remember called the Eagleford Shale. And there's this huge drilling boom there. And we saw this huge soaring of hiring in the oil and gas industry and hiring in manufacturing. And that's when all these developers figure, well, we're going to need more office buildings, or the oil companies told them they want more space. Now, we're not going to have the influence of the oil and gas industry coming out of this to support growth for Houston. What we're going to look like is we are going to follow pretty much the pace of what happens with the U.S. economy and the recovery. So if you want to look at measured just in jobs, this gray bar right here is the recession. And you can see throughout the recession, we lost employment. And even when the recession was over, we were still losing jobs. It gets back to that jobless recovery I talked about, where you can see production actually go up, see activity go up across all sectors, but employment remained flat or continued to decline as we just tended to get more efficiencies out of the system. And if you look, this one, the recession of the early 90s, it took us 24 months to get back to the previous employment peak. If you want to look at the one associated with 9/11 and in Houston with Enron, and you can see that, and we continue to lose jobs, even though the recession was technically over. Didn't start to see an upturn until about 2 years afterwards. And it took us 39 months to get back on a nationwide basis, to get back to where we were employment-wise. You guys can probably see where this is heading, and you look at the Great Recession and you see the drop off there. And even though GDP was growing again and retail sales were going in and home sales and construction was going in, we continue to lose jobs. And this little bump right there, it's a lot of the census workers, believe it or not. It's because we were taking a census then as well. And it took us 59 months for the nation. It took us 5 years to get back to where we were previously employed. So that's my real concern, is that this downturn is going to take us longer than many people realize. And that's another reason why we need to get some sort of stimulus package enacted to help nudge us along, to help us, to help that ball bounce a little bit higher, to help us out. So, if you ask me, what we really need to do is, well, I'm sorry, one more slide. So you can see we were in Houston. This is total employment, kind of follows that same pattern. We need to get all the way back to here, back to here. So the question is it going to be in January 22, or is it going to be further out where you can't see my cursor on the screen? So what we really need to do is everybody needs to cross their fingers that this recovery looks more like the recovery we had after the 1991 recession and not the Great Recession. If it's 1991 recession, we'll get back to our previous levels of employment in about 2 years. And even that seems like a long time. If it takes us longer to recover from this, it could be as much as 4 or 5 years. So with that, I'm done. Thank you very much. Bobby, I have about 5 or 10 minutes. I can take some questions, and then I actually have to be on a meeting at 1 o'clock. So I want to thank you, everybody, for taking time to listen to me.
Great, Patrick. Thank you so much. So if you do have questions for Patrick, go ahead and enter those into the Q&A function. We have our first question. It says, thoughts on economic impact if the current administration changes over in November? All right, right into politics, Patrick, your favorite topic.
Favorite topic. I don't know enough about Biden's policies. I know there's one thing you say to get elected, another thing you say once you're in the office. I think one thing, there will be some sort of stimulus package and some sort of infrastructure package if we see a changeover in administration. Let me back up and put it this way. As a Houstonian, you need to think about the industries which are key to Houston and how different candidates stand on that. So think about traditional energy and how important that is or has been. It's not as important as it was 6 years ago, but it's still important. Think about healthcare and all the people employed in healthcare and what candidate would affect healthcare employment. Think about all the ports we have in Houston, and I told you we probably have at least 20% of our economy is tied to being able to export. Think about that. And another thing we haven't talked about is population. I could have put it in here, maybe I should have showed it to you, but Houston is not growing. And I say the metropolitan area, not just the city. The metropolitan area is not adding population at the rate it used to. And if you look at over the last 3 years, we've had something called negative domestic migration, meaning more people have left the metropolitan area than have moved here from somewhere else in the US. We're losing people to other metropolitan areas. If it wasn't for international migration, our migration numbers would have been negative. The only population growth we've had has been because of the natural rate of increase, more babies being born, the 4,000 that were that Keith talked about earlier, and people are moving here from overseas. And when I say overseas, I'm not talking about undocumented. I'm talking about all classes, whether it's expat workers, whether it's people coming in on visas, whether it's people who are recruited by oil firms and engineering firms, or people recruited into the medical profession, all of that. So what you need to do, if you want to think about the change in administration or which candidate would be best for Houston, you need to stop and think about each individual industry and how that would affect an industry in Houston.
Thank you. Okay, next question. What is the prospect for education sector job growth?
I think the prospect is pretty strong, because I think even when we're trying to do it online, there is a need. My wife is a teacher. She's doing a hybrid model. She's doing both online and in classroom, and she does not have enough support. And the administration of schools is beginning to realize that. And I think you have to, the lesson plans are different, the way you have to do it. So yes, I think both private sector and public sector education, there is going to be a continued need for that. No doubt about it. The challenge will be, where will the funds come from that? Because we're going into a legislative session and the state budget is going to be challenged with the drop off in revenues from the oil industry, the drop off in sales tax, and other sectors. So the demand is there, the supply is there. What's missing is, where are the funds going to come from to meet that demand, to pay for that supply?
Okay, next question. What are your thoughts about the offshore oil and gas development? So offshore specifically. Offshore
specifically, that's a tough one. Offshore tends to be a huge capital expense. And what we saw leading prior to the pandemic was the oil and gas industry didn't want to commit capital over a 10-year period. They were trying to take that same amount of capital and put it into shale, where they could bring the wells on a lot quicker and generate cash flow a lot sooner. The thing is, it's a high capital expense, but it's where the cheaper oil is. So there's still going to be some offshore work, but I don't think it's going to be quite the same level. Because I think one of the problems is offshore is so capital intensive, and the markets don't want to lend any money to the oil and gas industry anymore. Right. They've seen what's happened over the last few years, both onshore and offshore. They're not getting their payouts. And they'd rather put the money into a software or a tech firm or some sort of alternative energy than into offshore. I still see the need for it. I just don't know where the funds are going to come from to fund it. Well, look at this. All my questions come down to money. Ha ha. Is it? So who's got a checkbook?
All right. Next question. What will the exploding national debt do to hold back Houston recovery?
Nothing right now. That's something, this exploding debt is unsustainable, but I heard a metaphor used, one of my fellow economists has used it. When the house is on fire, you don't worry about the termites. You want to put the fire out first. And that's kind of where we are now. We need to do something to get the economy growing. And if we got really strong growth, then we'll start generating some tax revenues from that growth that would help pull down the debt, or at least get it declining. I don't think we'll ever bring it down to zero, but if we show that we're reducing the level of debt, that's good. So Bobby, I have time for one more question, and then I'm going to have to let you guys go. Thank you very much for listening to me. I know I make some off the wall comments every now and then, but that's what happens when you've been working from home and all you have are 2 cats and a dog to keep you company during the day.
All right, Patrick, last question. With the ongoing jobless claims being elevated above the norm, is there any talk or speculation about how much of that is churn? So
that's a good point.
You coming in and out of the same jobs because of openings and shutdowns.
Yes, that's a good point. There is a way to look a little bit at that. I haven't had time to. The Texas Workforce Commission will give you a list. You can look at the number of filings by industry, and perhaps you can go into that. A lot of the claims have been in, early on, actually, we saw a lot of claims in healthcare, but that was related to doctors and dentist offices having to shut down. We're still seeing a lot of claims. The last time I looked at it, in the personal services and in restaurants and bars and so forth.
Okay.
And so that's initial claims. So yes, you could work for 2 or 3 weeks and then lose your job again. And there is, although I've heard talk of it, I haven't seen a study that there are some multiple claims that are filed in there. So that may be one thing that's elevating it. But there'd be multiple claims in the old data as well.
Okay. Well, Patrick, thank you so much. Really appreciate you giving us this time. That information is just, it's always fantastic and helpful. So
one other thing, if I can say, hey guys like Bobby, we're all doing our best to try to keep everybody connected. It's hard to network. It's hard to connect. We are trying to keep, so I ask you that please continue to support Bobby and support the Chamber for the work that they've done, because we will be out of this. And when we're out of it, Bobby runs a good shop. I look forward to, if Bobby will, inviting me back where I can stand at the dais and talk. But now it's not the time to ever pull your chamber dues. This is the time to continue to support them, because this is one of the few ways we can stay connected in this strange and awful time. So Bobby, I'll give it back to you. I'm sorry.
All right. And I'm going to end on that, Patrick. Thank you so much. Thank you for coming, everybody. And again, sign up for April. Hopefully we'll be back in person then, and we'll see Patrick again in person. And by the way, the Gary Larson joke did not go by without me catching it. So bye, everybody.
Bye. Thanks.